The garage is cold. Not vault cold, machine cold. The air smells of dust, cologne, and hot metal. Fluorescent tubes buzz over stained concrete, while air conditioners fight a Kuwait City summer that can blister a steering wheel in minutes. In 1982, nobody comes here to park. They come to buy a country that does not exist yet. Men in white dishtashas cut between folding tables and share certificates taped like laundry. Brokers bark numbers that have no oil well beneath them, no ship, no factory floor. The building is a parking structure with an older name, Souk Al-Manakh, a word that once pointed to a resting place for camels. By mid-year, the paper inside it is being valued near $100 billion. Kuwait is a small state on the Gulf. Its unofficial market is spoken of on desks in London and New York as the third largest stock exchange on Earth, behind only the United States and Japan. The contradiction is almost comic until you watch the payment method. The fuel is not cash in a till. It is a check with a date that has not arrived. In Kuwait, a check is not a polite request. To bounce one is a social death, and, under the law, a path toward prison.
So a check dated for winter can purchase a fortune in spring. Credit without a banker. Leverage without a margin clerk. A market writing the future as if the future already sat in the account. Then, one check refuses to clear. August 1982. A single instrument fails, and the fiction that held the garage upright begins to tear. When the state later gathers the wreckage, it counts 29,000 post-dated checks. Face value, $94 billion. About $90,000 of dead promise for every Kuwaiti citizen. This was not a palace of glass. It was a garage. The crash did not expose a shortage of hope. It exposed a shortage of money that had never been deposited. How does a parking garage become the third market in the world? And how does one rectangle of paper take the entire structure down?
Kuwait did not invent speculation in 1982. It inherited a problem every surplus state eventually meets. Too much cash, too few places that feel like they belong to you. In October 1973, Arab oil producers cut supply in the aftermath of war with Israel. Prices quadruple. For Kuwait, a country sitting on some of the world's most cheaply extracted crude, the windfall is not a bonus. It is a transformation. Government revenues leap. The dinar is hard. Citizens receive housing support, subsidies, public jobs. A merchant class that once financed dhows and dates now finances the state in reverse. The state is drowning them in liquidity. There is a catch. Kuwaiti commercial law is relatively strict about what may call itself a public company. Capital rules, shareholder counts, disclosure that established families can live with, and that promoters of empty shells cannot. The official Kuwait Stock Exchange, formalized in 1977, lists the known names: banks, insurers, industrial firms with actual ledgers. Those shares exist. They do not multiply fast enough to absorb a decade of oil rent, so capital looks sideways.
Across the Gulf, in Bahrain, the United Arab Emirates, and other jurisdictions with thinner company law, a new species appears: the closed Gulf Company. On paper, it is a corporation. In practice, it can be a name, a license, and a story about future trade. Because it is not Kuwaiti in the legal sense, it does not have to live under Kuwait's listing rules. Its certificates can still be bought and sold in Kuwait City by people who know one another, in rooms the official exchange does not supervise. The Souk Al-Manakh grows in that gap, not as a criminal alley, as a parallel salon. The official floor is for the respectable board. The unofficial floor is for velocity. Investors have already been taught a dangerous lesson. In 1976 and 1977, an earlier boom in local shares cracked. Prices collapsed. The government stepped in with support, purchases, and the implication that a Kuwaiti market would not be allowed to humiliate Kuwaiti families. Memory keeps the rescue and discards the pain. If the state saved the last bubble, why would it not save the next one? Then 1979 arrives. Revolution in Iran. Another oil shock. Another flood of surplus.
By 1980, a Kuwaiti household with land, a civil service salary, and cousins in trade can feel,
not imagine, that paper can outrun wages. Expatriate workers build the towers and staff the ministries. Citizens, a minority in their own census, hold the political claim on the oil. Investment becomes a patriotic sport and a private contest. The official exchange cannot list what does not qualify. Brokers therefore carry the unqualified names into the parking structure, where hours are long and rules are social. Premiums for Gulf Company shares detach from any audit. A firm that has never loaded a crate can trade as if it owned a fleet. New companies are floated, not to operate, but to be traded. What most outsiders miss is that this is not hidden in the way a numbered account is hidden. Taxi drivers know the rumors. Ministries know the volume. Banks see the checks moving through clearing and choose, for a long time, to treat them as ordinary instruments. The fiction is public. The supervision is not. Kuwait's central bank can watch liquidity. It cannot easily police a market that insists it is only a gathering of private sales.
The Ministry of Commerce can police registered Kuwaiti companies. The shells are registered somewhere else. Jurisdiction becomes a hallway with no door at the end. By 1981, the unofficial board is no longer a sideshow. It is the place where status is priced. A family that stays out looks timid. A family that writes forward paper looks liquid, even if the account is a weather forecast. The official exchange still exists, still prints closing prices for real firms. It is simply no longer where the country's heat is. That is the blind spot. The surplus had to live somewhere. The rulebook told it to live offstage. They called them the Magnificent Nine, not a government title, a market nickname, half envy and half joke for a cluster of traders whose paper fortunes had gone vertical. In the first months of 1982, they are treated as proof that the unofficial board can mint a new aristocracy faster than oil can mint an emir's budget. Their names circulate in diwaniyas, the evening gathering rooms where Kuwaiti men talk politics and money until midnight. To be seen near them is to be seen as liquid. Watch what they actually decide. They do not merely buy a share and lock it in a drawer. They buy with a check dated 90 days out, then use the same rising certificate as social collateral for the next check and the next. Each signature is a bet that someone else's signature will remain sacred. The nine are not required to be engineers of companies. They are required to be engines of bids. Around them, a wider public climbs the same ladder with smaller rungs. A ministry clerk hears that a Gulf name doubled in a fortnight. He writes a check against a salary that cannot cover it, trusting the rise to arrive before the date. A widow is told that idle land is the real risk. Shopkeepers, teachers, young men back from London colleges enter the garage after hours as if entering a club. Retail is not a side current. It is the sea the nine swim in. The promoters have a different motive. A hollow company listed on the unofficial board is a printing press for certificates. Float the name. Recruit a story about shipping or food or construction in a neighboring emirate. Sell the story into a room that has decided stories are assets. The promoter's hidden incentive is not a dividend in 5 years. It is the spread on day one, paid in paper that the law treats as cash. Banks are not spectators. Loan officers accept share certificates and post-dated instruments as if they were treasury bills. Saying no is a career risk when every competing desk is saying yes, and when the borrower may be a family that also sits on your board. The motive is not cartoon villainy. It is the fear of being the last prudent man in a city that has priced prudence as stupidity. Then there is the check itself, which is less a document than a character. Kuwaiti commercial custom and statute made the dishonored check a wound to honor and a matter for prosecutors. That fact is the hidden motor. A trader who would never hand a stranger unsecured credit will accept a dated check because the state's jail and the family's name stand behind it. Honor is doing the work of a clearinghouse. Reputation is doing the work of a haircut. One life or death decision repeats until it feels like weather. Roll the paper. When a check's date approaches, do not pay it down from earnings. Issue another, larger, longer. Buy time with size. The nine do this at a scale that turns them into nodes. If they keep signing, the network holds. If one of them stops,
the network discovers it was never a market. It was a circle of names. It will not stop.
Prices in 1981 stop pretending to be prices. They become scores. A Gulf company with no published earnings can double, then double again, because the last buyer used paper dated for a season that has not started. Volume on the unofficial board swamps the official floor. Some certificates change hands so fast the physical share is almost a rumor. What exists is the chain of checks behind it. Men look at the person opposite and ask whether his date is still good. The arithmetic is already impossible. The stock of post-dated instruments outstanding is growing faster than the deposits that could ever honor them. Each new high requires a larger future check to validate the last one. This is not a secret to every banker. It is a secret that cannot be spoken without crashing the speaker's own book. Summer thickens. Rumors move through the Diwaniyas that a large name is late. Late is a word people use when they are not yet willing to say insolvent. A trader who has been a node in the web needs cash that is not a signature. He does not have it. The returned check is only a starting pistol. And then, everything breaks. Not as a speech, as a chain.
The payee who did not get paid cannot meet his own date. His payee fails the next morning. By the end of the week, the question is no longer which company is sound. The question is which signature is still attached to a living account. Because so many trades were circles, A owing B, B owing C, C owing a single failure is a proof about the whole ring. Brokers stop answering. Certificates that were treasures on Sunday are unsaleable on Tuesday. The official exchange, which had told itself it was the grown-up market, discovers its own listed banks and firms are counterparties to the unofficial rec. Share prices on the regulated board gap downward. Credit officers who treated forward checks as near cash open drawers and find criminal evidence, or find nothing that can be marked to a market, which is worse. Clearing ceases. A bank cannot be sure whether a customer's deposit is money or a claim on a man who is now a defendant. Interbank trust, the dull miracle that lets a city function, thins out. Importers who never bought a Gulf shell still need letters of credit. Those letters slow. The crash leaves the garage and enters the grocery ledger.
The government cannot pretend this is a private salon. If it does nothing, solvent businesses die beside the speculators, and the dinar's reputation travels with them. If it pays every check at face value, it converts a gambling debt into a public debt and teaches the next boom that dates do not matter. The cabinet is choosing between moral hazard and a payment system heart attack. They choose a third path that is really a maze. Trading in the unofficial shares is halted. The state orders the gathering of the outstanding instruments, the entire web of dated paper, into a central pile. A settlement body is created to do something courts cannot do quickly: net the circle. Who owes whom after all the arrows cancel? The pile is not a metaphor. It is tens of thousands of checks, each one a name, a date, a sum, and a story. Lawyers sort small drawers from large ones. A clerk who wrote one impossible check is not the same political object as a node who signed 1,000. The government draws thresholds. Below a line, many small participants will be handled with more mercy, because punishing every household would empty the streets of any remaining consent.
Above the line, the large debtors face courts, negotiations, and in some cases prison, because the check law is still the check law, even after the market that fed on it is dead. Netting a circle of this size is not arithmetic for a clerk with a pencil. Claims point forward, backward, and sideways. A man can be a creditor in the morning and a debtor after lunch on the same piece of paper through 3 intermediaries. Kuwait brings in systems and mathematicians. Linear programming, the same family of optimization used to schedule refineries and armies, is applied to a national disgrace. The computer's job is not to restore the dream. It is to find a feasible settlement, a set of payments and write-downs that does not violate the collected facts. Years go by. 1983 is not a recovery. It is an inventory. 1984 is arguments about who is a victim and who is a designer. Banks that look solvent on last year's letterhead require quiet support, rescheduling, the state's shadow on their liabilities. The central bank is no longer a spectator of liquidity. It is a field hospital. Then, oil turns against the rescuers.
By the mid-1980s, crude prices slide.
The surplus that once fed the unofficial board thins, just as the settlement machine needs patience and cash. Every dinar used to keep a bank upright is a dinar not used for the welfare bargains that made Kuwait feel insulated from consequence. Families discover that a check in a cousin's drawer can freeze a marriage, a shop, a passport. Lawsuits last longer than the companies that caused them. The magnificent myth dies the way those myths always die, not in a single trial, but in 1,000 appointments with lawyers. By the late 1980s, the programming models have done what they can. Obligations have been netted, discounted, assigned, in some cases absorbed. What returns is caution and a banking system that has learned to flinch. Credit becomes a flinch before it becomes a signature. The wound stays open in a different way. In August 1990, Iraqi tanks cross the border, and the remaining paperwork of the crash is buried under a larger catastrophe. Historians will still be untying 1982 after the liberation, because a circle of names does not care that history moved on.
A market is supposed to be a machine for prices. Souk Al-Manakh was a machine for dates. That is the principle the wreck leaves behind, and it does not belong only to Kuwait. Wherever people treat a promise as if it were a deposit, they are doing what those traders did, even if their paper is digital and their garage is a screen. The check was never interesting because it was paper. It was interesting because a whole legal culture agreed to treat a future Tuesday as cash on Monday, and because that agreement worked until it was tested at scale. Intention and outcome split cleanly here. Many buyers intended to be rich, not to destroy clearing. Many officials intended to avoid humiliating families, not to underwrite a pyramid. The Gulf companies were intended, in the brochure sense, to be businesses. The outcome was a web that could be solved only after it had already failed, and only by treating human signatures as variables in an equation. The human stakes are smaller and stranger than a morality play. A society that had been told oil made it safe used honor to manufacture a second, faster oil.
Status moved from land and lineage to the ability to sign a date that other people feared. When the dates came due, honor did not disappear. It became a weapon. Families that had been careful with guests were suddenly careful with cousins. The same rule that had inflated the boom, a check must be sacred, made the bust into a criminal census. The instrument that failed was not an exotic derivative cooked in a foreign bank. It was a check. The same object a grocer might take for a delivery, the same object a family might use to buy a car. Because everyone had written a check for something real, it felt sane to write one for something that had not been built. Stand in the mind's eye in that structure after the tables are gone. Concrete remembers nothing. Heat presses against empty ramps. The mystery is not that speculation exists. The mystery is how ordinary tools, a statute about checks, a border between company types, a memory of a government rescue, an evening room where men talk, can be wired together until they hold the weight of a national balance sheet. Other cities have their own versions of forward paper. Some call it trade credit.
Some call it a handshake in a private market. Some call it a platform balance that cannot be withdrawn until a cycle ends. The names change. The temptation does not. To let social fear do the job of a haircut, and to call the result liquidity. Kuwait as a state did not vanish. That continuity is the aftertaste. A crisis can empty a garage and still leave the flags on the buildings, which is how a society learns to remember the boom as an episode instead of as a design flaw. The design flaw remains available. Any community that is small enough for reputation to travel and rich enough for paper to outrun work can wire the same circuit. Kuwait spent years asking a computer who owned the ruins. The computer answered with a ledger, not a verdict. How many markets, right now, are only a date that has not yet arrived?